Good morning and welcome. Thanks to each of you for joining this morning. We're awfully glad to have you. Thanks for dedicating a portion of your morning to what's our long-term tax strategies session today. I'm Ryan Green, advisor with Brand Asset Management Group. Hope each of you are well. It's been a very challenging year and a half, and it's been really good to do the events that we have been able to do when we've been able to do them. And while very few of them have actually been in person over the last year and a half, we've still tried really hard to share as much good information with you all as we possibly can. We're honored today to have a couple of accountants from the St. Louis accounting group, Lopata Flegel Company, join us. We've worked with both of these individuals for a number of years. We know them well. We think they do a great job. The first of which is Patti Myers. She is a principal in Lopata's Tax Services Department. She's been with the firm since 2004. She is an expert in a wide range of tax disciplines, ranging from personal and business taxation all the way to special needs planning. In fact, she's got a special place in her heart to work for nonprofits, helping those individuals that maybe suffer from various disabilities. And the clients that we have that have the opportunity to work with Patti just absolutely adore her. She just does a great job for them. Joining her is Michael Durkin. He is a tax manager at Lopata. He's been with the firm since 2012. He is highly skilled, technically competent in many areas of tax and tax strategy and planning. He's just been a great asset to a number of our clients over the years. He's just got a great mind for not just what is in the tax code, but what strategies can we leverage to really extract the most benefit we possibly can from a seemingly ever-challenging and ever-changing tax system. So before we get started today, I did want to just outline a few housekeeping items to keep in mind. The first of which, of course, I have to say, right, that we're going to be covering concepts that impact not only taxation, but also some areas of estate planning. Every individual situation is different, so we would highly recommend that each of you consult with your own tax and estate counsel before contemplating making any significant changes. Also, we're going to spend some time today talking about what is in the winds as far as changes that may become. You know, there's a lot of proposals being discussed right now, touching on many different areas, but they're just that. They're proposals. As we sit here today, nothing has been signed into law. So just keep that in mind, that any of the things that we talk today about proposals could change, they may be altered, they may or may not even make it into final law. So we're going to do the best we can to talk about what we see right now, but just remember, nothing is law yet. Also, there's a lot in the proposals that we're not going to cover today, and quite frankly, it's because there's just so much of it, so many things that are being talked about right now. We would probably have to have a daily session to come anywhere near covering everything. So we've tried to select those things that would be the most relevant, impactful for the families that we do work with. But just know, especially when it comes to Patti and Mike, they know so much more about the proposals right now that extend far beyond what we'll cover today. So to the extent any of you have any questions that you may have brought to the discussion today or that may come up as we move through some of the material, there is a chat functionality. Through your screen, you should have a little icon that references a little chat bubble. Please do type any questions you have into that. We're going to do our best to reserve some time towards the end to answer as many of those questions as we possibly can. So with all that out of the way, we can go ahead and move forward here. And I thought we'd start out today with just a little bit of humor because, well, let's face it, you know, if we're talking about taxation, having a little bit of humor in mind is probably going to be a good thing to help get us through it just a little bit better. And so we selected this cartoon, and I was struck as I was looking at different cartoons. You know, there's a bunch of them out there, obviously. I was struck how many of them somehow involve death, which, you know, not only is it just kind of amusing to think about it that way, but it is grounded in some form of reality, right? I mean, death and taxes being that classic thing, you can't avoid either one of them. And if you can't avoid it, well, you might as well do the best you can to make the best of the situation. Which, as we talk about, it really does boil down into what we think is a fairly simple concept. If you acknowledge that of all the money that you and your family spend on any number of things in your life, probably the top of that list, the thing you may spend the most money on over the course of you and your family's life is in fact taxation, which makes it pretty important, right? At least we think so. And with that in mind, we really do like to position tax planning as tax planning. You have to have a strategy, you have to have an understanding, you have to be educated on not only where taxes are today, but where we think they may be in the future. Of course, predicting the future is a pretty challenging thing to do in most cases. So you do the best you can to again, be informed, to make logical decisions, have a strategy, and then execute upon that. And so it's my opinion that if you really want to try to figure out where you're going, it's useful to have a good understanding of where you are and where you've been. And so the first part of the presentation is going to be a commentary along those lines. Where are we? Where are we in relation to tax codes throughout history? And so we'll start with some thought on corporate taxes. And I know there's a lot of data on the screen here, but if you'll pay particular attention to the left-hand side under the corporate tax rate, the average corporate tax rate, highest rate I should say, is summarized by decade, starting back in the 50s when it was 50.9%. And then you can see it's actually come down, generally speaking, over the years. It's currently 21, which when you compare it to the rates we saw in the 50s or 60s or the average rate of 42, is actually quite low. In fact, the rate of 21 is the lowest corporate tax rate we've seen since the 30s. And as a quick little sidebar, just because I know this question comes up a lot, and we do answer this question a lot, and it really is, well, if corporate taxes are going to go up, doesn't that mean bad things for stocks? And we would say, not necessarily. In fact, if you look at, for the 50s, for example, here, when the rate was 50.9, you can see the S&P had its best decade return over that time period. Conversely, if you look at the 2000s, when the corporate tax rate was actually quite low by historical standards, well, there was a not great return for the S&P 500 during that decade. So there's no direct relation to high or low corporate tax rates and how well the stock market does. There are just so many other factors that come into play that you can't really draw a causational line between taxes and stock market performance. But it does reinforce the idea here that we are in a very attractive corporate tax rate environment. Transitioning a little bit to ordinary income rates, this graph represents where the top marginal rate on ordinary income tax has been since the inception of the federal income tax, which was introduced in 1913, right before World War I. And you can see how it's moved throughout time. It's been higher and it's been lower. Of note, you'll notice that when we get into a period of war, World War I, World War II, that has led to, essentially, higher ordinary income tax rates. And in fact, following World War II, when the rates went up, they actually persisted at a fairly high level until about the 60s, when that rate really did start to generally fall to the point today that it's at 37%, which does mark the lowest rate that we've seen since the Reagan tax cuts of the 80s. The blue, or the bottom line there that you can see, is just where the lowest marginal rate has been over that same time period. You can see it's been much more stable. It's really hard to move up the lowest rate too high, and you can't really take it too low. So it's been fairly stable over the years, but even at 10% now, still is a bit lower than where it's been throughout history. A little bit of a different time period here, but again, the blue line represents that top marginal rate on ordinary income. This here just since 1954, but we've added in a graphic on the maximum capital gains tax rate. And that's been much more stable than the ordinary income rate over those years. And as we sit here today, it's at 23.8%. Which you may say, well, wait a minute, I thought it was 15%. And true, most people do pay 15% federally on long-term capital gains. The 23.8 actually represents the top rate of 20 that's applied if your income is high enough, plus the additional surtax on net investment income tax, commonly called the Obamacare surtax, of 3.8%. Even that rate is lower than it's been in various points in history. And again, most people actually do pay a rate that's a little bit lower than that currently. On the estate tax side of things, I thought this was just a fascinating graphic to look at, because if you look at the historic estate tax exemption, which that is just if you have an estate, a certain amount of it could be subject to estate tax, but only the amount that's in excess of the estate tax exclusion amount or exemption amount, which is represented here. And you can see it really didn't exist for the longest time. There really wasn't an exemption But then beginning in the 70s, they began to introduce that idea. And in fact, as recently as the early 2000s, that amount was only $500,000. Well, you can see how that's escalated over recent years to the point now that it's $11.7 million per person. So a husband and a wife together could have up to $23.4 million of lifetime estate tax exclusion. Obviously, that's the highest exclusion amount that we've ever seen, with the exception of 2010, which is a little bit of an anomaly. That was a year where there was actually no estate tax exclusion, or unlimited estate tax exclusion amount, I should say. But if you just look at the quote normal years over that time period, we are at a point where it's as high as it has ever been. So if you actually do have an estate that's over that exclusion amount, it can be subject to estate tax. And the rate that that tax represents has also changed throughout time. And this graphic represents exactly that, going back to 1916 when it was introduced. It started out and has moved up and down a little bit over the years, plateaued in the 40s following World War II, and kind of like ordinary income tax rates, has fallen a bit since the 60s and 70s, to the point now that it's at 40%. Again, outside a very brief period in the early 2010s, that's the lowest rate we've seen since the early 30s. So thematically, there's a little bit of a trend developing here, right? And it really is this idea that if you consider where taxes are right now from both corporate, ordinary, capital gains, estate tax exclusions, estate tax rates, these rates are all quite accommodative compared to various points throughout history. And that's important to keep in mind because it does lead to the question, well, how long is that going to be the case? And that's really one of the primary objectives for today's discussion, is to talk about how long that might be the case. And so as an introductory kind of thought on that very topic, here is a representation of the federal budget deficit going back to 1980. And it's called the federal budget deficit because it's very rarely a surplus. In fact, there's just a handful of years there in the late 90s or 2000s where it actually was a surplus. But for the most part, the federal government has run at an annual deficit. That's not a new thing at all. But what is a little bit more recent is that beginning following the financial crisis in the late 2000s, you've seen an escalation of that annual deficit. A little bit higher when the financial crisis was really taking hold and we were recovering from that. And then it fell back down into the teens, but has really escalated primarily in response to the global COVID pandemic. The government did what the government tends to do in periods of crisis, and that's to throw as much money as they possibly can at the problem. And we saw several different rounds of stimulative efforts on a number of different fronts, personal and business, to try to help people and the economy recover and still continue to recover from the global pandemic. And so you can see that really has resulted in escalation of the annual deficit. Here we plot U.S. debt throughout history as represented as a share of public versus GDP going all the way back to 1790. I always love when we can show a graph that goes all the way back to 1790. And there is a theme here that's worth pointing out, and that is in periods of crisis, the government spends and borrows more. You can see that was true following the Revolutionary War all the way back at the beginning of this graph. And then as there was the Civil War, World War I, the Great Depression, World War II, financial crisis 2008, the COVID pandemic, that really has led to an escalation of government spending and of government debt. And so if I could, I'd like to tie that back to some of the graphs that we saw earlier. The first being this individual income tax rate graphic. You can see that following World War I, high levels of spending, high levels of government debt, we saw a significant increase in the top marginal tax bracket rate. Following the Great Depression, World War II, exact same thing. High levels of spending, high level of debt, significant increases in tax rates. If you look at the estate tax rate, kind of similar. It went up following World War I. It went up significantly and stayed there for a while following the Great Depression and World War II. Now, it's really difficult to try to predict exactly what's going to happen next. So this is where you fall back to, hopefully history is some kind of a guide. And hopefully following history gives us some idea of what may happen in the future. And I think it leads to the general idea that taxes aren't going down. If anything, taxes are going up. We don't know how fast, we don't know who might be impacted, we don't know exactly when, we just don't know the certainties of it. But the thematic idea is that taxes are likely to go up and much, much, much less likely to go down. In fact, that's being talked about right now. I mentioned that a little bit earlier, that there's several proposals making their way through that would significantly impact the tax and estate tax side of things. And Patty's going to give us a little bit of an idea of what some of those are.
Ryan, thank you. That was a great job just summarizing the history and setting the table for this discussion. So I appreciate that. So in terms of what I'm about to talk about, really the Build Back Better Act is what is a lot of people have heard. It's been in the media as the 3.5 trillion. So that's the piece, that's the act that we're going to get into some more details on that proposal. And again, just to reinforce it at this point is just a proposal. There's a lot of talk that is probably going to be pared back somewhat. If that occurs, and if this does become law and it's pared back, some of the things we're going to talk about might, the revenue raisers might be adjusted as well. I would expect they could be. So just want to lay that out there. So in terms of the things, as Ryan kind of, showed you the graphs on those charts, there were a lot of those rates that are pretty low. Corporate rate being the one that certainly stands out. So that's one that's on the table. The individual rate, and even in Biden's candidacy, he threw out the threshold of the 400,000. He didn't want to raise taxes on people below that. So you're going to see that theme throughout this. That 400 to 450,000 is a threshold on a lot of those increases. Also, there's some more things that will impact estates, taxation of estates and trusts. So those are really, a summary of what they're looking to do. So first, we have the president who had a tax proposal that outlined some of his goals. Some of those are not in this latest Build Back Better Act. So there's some, namely the biggest one that I think a lot of people were concerned about had to do with step-ups at death and deemed sales upon death. So that is not in this as it currently stands. But the House Ways and Means Committee, they released their proposal back on September 13th, and that's an important date we'll get into later. But they have that proposal out. The Senate Finance Committee has been working with the White House and the House just to develop a framework and a general agreement upon what the revenue raisers might look like. But just to reinforce, you're going to see that last bullet point, which has somewhat changed from the time we wrote this even. So, you have several people, several in the Democratic Party who are not comfortable with that 3.5 trillion. You have Senator Sinema and Senator Manchin. So Pelosi has even come out to indicate that she expects, it's becoming self-evident that will likely be pared back. The goal in the Democratic Party was that they'd have a vote on this bill by today, but that has really been overshadowed by some other non-tax related provisions that need to be dealt with. Namely, today, the vote to continue the government. So if they don't get a vote, then they won't have the government funded, and there likely will be, some government shutdown at some federal level. So that's the most important. Also, some other non-tax related legislation that's pretty critical. You've probably heard about the debt ceiling. Janet Yellen, the Treasury Secretary, has said that's mid-October that they're going to need to increase that. So that's also something that those two provisions are somewhat taking priority. They did want to tie those together, the Democrats. So we'll see what happens there, but it's unlikely at this late date that today they'll have a vote. I don't expect they'll have a vote on that Build Back Better Act. So, but in that act, one of the things is to significantly fund the IRS, which for practitioners, other CPAs, we're all having the worst experience with the IRS service that we've ever had over the last year and a half. So, you know, they're understaffed. I don't even know how to describe how poor the service has been, but if you've been tried to call the IRS, you have a little idea of what that service has been like. So they're talking about in this legislation, there's nearly $800 billion over 10 years funding. So we'll see where that lands, but I just wanted to mention that. And we can move on to the next slide. So now getting into some of the specifics within this act and what some of the proposals are that we think are going to be relevant to this audience. So first, corporate taxes. As Ryan showed, our most recent rate is 21%, and that came into play at the end of 2017 with the Tax Cuts and Jobs Act with the Trump administration. So that became a flat 21% on corporations. Now they're going to, this proposal is a graduated rate. So starting that first 400,000 would be at an 18% rate. The next, from 400 to 5 million would be at a 21% rate, so the existing rate. And when you get over 5 million for corps, it'll be at the 26.5 rate. And then if you have a corp over 10 million, they lose those graduated rates. So that's really the impact. If you're hearing about corporate rates increasing, that's what's in this proposal. There's also a very dealing in foreign income taxation, which is a very complex side of the law that's really gotten complex over the last few years. There's a significant amount in that we won't go through. But just wanted to throw that out there. There is a lot in that. So, and part of our goal in this presentation is to provide some, planning opportunities if these provisions pass. So if there's someone out there where you're a closely held owner of an S Corp, some of the planning opportunities, you might work with your CPA, or, if depending on where that taxable income is, maybe you maximize those graduated rates. And another thing that it's way too early to really make any recommendations on this, but always a consideration is potentially become an S corporation, make an S election. Obviously, when you do that, you then now have flow-through income as an S Corp shareholder. So your accountant would really need to look into all the other proposals. If this becomes law, all the other proposals that impact 1040 taxation to determine what that would look like, but that's always a consideration. So if you want to move on next, thank you. Okay, so moving on to individual taxes. So we have a lot in the audience that are business owners, whether they have a sole proprietor, single member LLC, they're owners in S Corps or partnerships. There's three proposals that we would just want to talk about and kind of, let you know kind of the changes that they're proposing. So the first is net investment income tax. And so the net investment income tax, as Ryan did mention earlier, came about with the Affordable Care Act. And historically, what that has been is an additional tax on investment income. So that's your dividend, interest, capital gain. If you're an investment, if you own investments as a passive investor, those type of things, that income, if you're over certain thresholds, if you're what would be considered higher income, 400,000 plus, would be subject to this 3.8% surtax. What the current proposal does is to take that net investment income tax and subject trade or business income that is not already subject to self-employment taxes. So it brings in what would be non-passive, so people that are active in a trade or business, potentially an S Corp, let's say, it would bring that ordinary income subject to another 3.8%. So that was a pretty surprising one to me because the intent originally was really for investment income. So anyhow, so that's the first one. The second one has to do with qualified business income. Now, this is a provision that came into law with the Tax Cuts and Jobs Act, effective starting in 2018. And it is a 20% deduction on qualified business income. The intent of it was really, it corresponded to that 21% corporate rate. And the intent was that any businesses that qualified, that income would be more in line with a rate like the corporate 21% rate. So that was the intent of this law. It did have a lot in this, as it originally exists or as it exists today, it has a lot of limitations already. It has a limitation depending on what your business is. So if you're in what they call a specified service business, usually professional services, it's going to be your brokerage, your law, your accounting firms, things of that nature. You could, if your income is high enough, you lose out on this deduction. There's a limitation if your income's high enough based on the wages the business creates and the fixed asset that it has. And then overall, there was a limit on as a taxpayer, your taxable income. So there were the limits that already existed. What this new provision says is it says, okay, look at all those, but then also there's an overall ceiling on the deduction. So for a single person, there's a $400,000 deduction maximum, $500 for married and only $10,000 for a trust or estate. So that is a further limit. So, if you have an incredibly successful business, this could really impact, people that might have $1 million deduction now just lost half of it if they're married filing joint. So that is that proposal. And then the third one has to do with excess. It's called the excess loss limitation for non-corporate taxpayers. And that is something that, again, came into law with the Tax Cuts and Jobs Act. And it effectively got postponed with COVID. So with COVID, Congress came out with the CARES Act, and that kind of delayed this provision. But what this provision does is you net your business income, but then any other income, any other forms of income, when you have a loss, are limited in how much of that business loss can offset things like wages and investment income. So if you're married filing joint, that was somewhere around $500,000. If you're single, that was $250,000. So those limitations, which are effective now in 2021, as it sits today, that provision is set to sunset and go out of the law after 2026. But what this act would do would be to make that provision permanent. So that's really the difference. It's just to make it permanent going forward. So, okay, thank you. All right, so proposed ordinary income rate. So here is a great visual of the current rates as they stand today and the proposed rates. And you'll see the two things I want to point out the most in this slide. If you look at the married filing joint 35% rate, it really is a very compact rate. It's shrunk so much. So, if you're married filing joint at 418,000, you're at a 32% top rate. But by the time you go to 450, just over 450, you're at a 39.6, which is a pretty significant jump, right, between 32 and 39.6. So I want to point that out. And again, that corresponds to what Biden's thoughts were early on of that. Remember, we talked about that 400 to 450 threshold, and you'll see in the single section, by the time you're, if you're a single taxpayer, by the time you're at 400,000, you're at the top rate, and married filing joint, it's 450. So that kind of corresponds to that comment about raising taxes on people over that. Also, you'll kind of, note the marriage penalty that's innate in this. If you look at the single rates at 35%, it starts at 209,000, whereas in the married rates, that same bracket of 35 starts at 418. So, you know, that's not so bad for the marriage penalty, but we'll move on to oh, not yet, sorry. One more thing to note in this proposal has to do with, they're adding another surtax, which they're saying is on modified adjusted gross income over $5 million. So if there's a taxpayer, whether single or married, a taxpayer with over $5 million of modified adjusted income, so that's effectively your adjusted gross income less any investment interest expense. That'll be subject to another 3% surtax. So effectively, those people are going to be at a top rate of 42.6. So, okay. And capital gains taxes. So this is where you'll really notice both in the current and especially in the proposed, the marriage penalty exists. So you get to the top rate, which the top rate currently is 20% plus the 3.8 in net investment income. Now it's going to go to 25. So you'll see that's at 400,000 if you're single, but at 450 at married filing joint, you're maxed out as well. So, and one thing I do want to point out about this, I said that date of 9/13 when this Build Back Better was proposed. That is the effective date for capital gain transactions for this new 25%. So if you're, if you have enough taxable income, you're not going to be at the 20% that you would be if your transaction occurred before that date. You'll be at the 25% rate.
Which some of you may remember a number of years ago, it was discussed that capital gains rate was going to go up. Under that proposal, however, they granted that to start the following year, which means you could actually go in, and we had actually several clients that went in and intentionally realized a lot of capital gains under the fear that it might go up in the future, that the rate may go up in the future. Turns out that didn't happen, at least that year. But the troubling thing here with this proposal is exactly what Patti mentioned, that if it's passed, you really can't do anything about it because it would be effective basically after 9/13, which last time I checked the calendar, we were well past that date.
Right.
So
right.
It's one of those where if they put it in, and they really want to stop people from being able to intentionally realize gains before the end of the year at a seemingly better rate.
Right. They took away all the planning that we could do at that point. So that's correct. So, all right. You can move on. Mike, I'll leave it to you.
I will take over now after the great outline by Ryan and Patti. Kind of seen historical tax rates and some of these proposals on where rates might be going, which, in our estimation is up. If you think that Congress can get something through and get this done, rates are certainly going up for some taxpayers. Now, there's a whole bunch of other provisions. The Ways and Means Committee outline was 18 pages long with dozens and dozens of different things. So we certainly can't hit on all of it, but we want to point out a few of the things that we think are most relevant for people on this call, and then a few planning points as a result of this, or just general tax planning points that should be considered every year. Tax planning can't be done after the end of the year usually, and it can't be done once in a lifetime. You really need to be working with your advisors at Brand. They have a great team there and are very knowledgeable about this as well, and your accountants and lawyer, estate planning attorneys, and really get a handle on this every year. So some of the biggest provisions in this are around retirement accounts. And the first one, we have dozens and dozens of clients who utilize this loophole, if you will. It would prohibit the conversion of after-tax retirement dollars. So most traditionally, IRA dollars. You make a non-deductible IRA contribution because your income's too high to make a Roth contribution, and then immediately convert it to a Roth account. So that would be prohibited after 12/31/21. The planning point there would be ensure all those 2021 contributions and conversions are done before the end of the year. The summary isn't the exact law how it's written, but it implies that any conversions after 12/31/21 would not be allowed. So that to us implies, this would have to be done before the end of the year, both the contribution and the conversion, even though you technically have until April to make the contribution. The second bullet there would be just eliminating Roth conversions altogether. And you see that odd date of 12/31/31. So certainly subject to change by then, but that must be some budgetary deadline where this is where it fit into some sort of budget and numbers, and they make Roth conversions prohibited for what they call high income taxpayers after December 31, 2031. So there's certainly still time to make Roth conversions. There's definitely some advantages to that, which we'll get into in a little bit. And that should be something that should be looked at with these, relatively low tax rates that we currently see. And, to Ryan's point, we've just spent a whole lot of money with the federal government. So this might not be the stopping point either. This could be the start of increased tax rates. I don't want to be too alarmist, but, seemingly rates right now are pretty low, especially for business owners. Certain provisions around high dollar retirement accounts, the Peter Thiel rule, people probably saw articles. He has a $5 billion+ Roth IRA. Congress doesn't really like that, allegedly. So required distributions would have to be made from IRAs, 401ks, all retirement accounts if your cumulative balance exceeds $10 million. And that again applies to the high income taxpayers only at that $400,000 and $450,000 threshold. If you're over 20 million, they're actually going to require you to take the money out of Roth accounts. They want to eliminate that tax-free growth. So you first have to take it out from Roth accounts down to 20 million, and then you can pick. The last one, this is kind of interesting, and it kind of snuck in there. Again, probably related to Peter Thiel and the investments that he was making in his Roth accounts. They would prohibit you from investing in securities that require a minimum asset or income level. So accredited investor that typically requires $1 million asset level or certain income levels, or qualified purchasers, which is a $5 million asset level. So there would be a 2-year grace period to sell those investments, but the issue is many of those investments are very illiquid. So it's kind of interesting that this was put in there because, I suspect some members of Congress and even some lobbyists and others wouldn't want it in there. So it's kind of interesting that that's in there, but it is in the proposal and it'll have to be managed. I mean, that's probably not the bulk of most people's retirement accounts, but it certainly impacts some. Next slide. Estate taxes. We saw that nice chart earlier with the estate tax exemption, which is at the highest level it's ever been. It's automatically going to cut in half in 2026. These proposals would have that happen next year. So you actually would have until the end of the year to make gifts, or possibly to make gifts, or consider some planning before then. And that would really be for the estates that are projected to be over the, about $12 million in total. That should be seriously looked at. No changes to the annual gift exclusion of $15,000. So you can gift $15,000 per person, per spouse, to anyone and not have that impact that total lifetime exemption amount. So that's very valuable, especially when you consider kids, grandkids, spouses of all of them, if you wish. That can be a really valuable tool to get money out of a taxable estate. One thing that Patti noted earlier, these proposals don't have the provisions to tax capital gains at death. That was being pushed pretty heavily by the White House, and that's not in these proposals. We don't know with certainty that it can be added back in, or that this might not be on the table in a few years. But at this point, that's not in there, which is a pretty big relief to a lot of taxpayers. Even if you didn't have a taxable estate, you would still be subject to capital gains tax on a big portion of investments if the value of those had increased. So that's a pretty beneficial thing on the estate tax side. One area of great concern for those who might have taxable estates is they're changing the rules and tax benefits for grantor trusts. Common grantor trusts are irrevocable life insurance trusts, spousal lifetime access trusts, or you may hear intentionally defective trusts, either intentionally defective irrevocable trust or intentionally defective grantor trust. Old trusts would be grandfathered in, but our understanding is new transfers might be subject to the new rules, and certainly new trusts would be subject to those rules. And that would all be effective at the date of enactment, so not necessarily the year end, whenever this law is enacted. If we go back to the Tax Cuts and Jobs Act, that wasn't actually enacted until December 2017. So that was the last major tax reform under the Trump administration. So perhaps there's some time, but you know, the main takeaway is if your estate might be approaching that, you know, 10 million, 12 million plus dollar range, certainly discuss some of these strategies with your accountant and estate planning attorney and figure out if anything needs to be done. So some planning strategies as it relates to this and just general good practices. You know, look at this every year. Next slide. And ensure you're looking at, you know, the full scope. If you're employed, you know, consider traditional 401k versus Roth. Maybe your income situation has changed or you got a large bonus in a year. All that can impact your tax rates. And with that top tax rate potentially creeping in at 450,000 instead of, you know, well over 600,000 for married, that could impact a larger number of taxpayers. You know, Ryan might have some input on this. Traditionally, if you're in the 32 or plus % bracket, a traditional 401k might make sense. If you're lower, maybe go the Roth or split between the two.
Yeah, that's just one of those difficult things that, you know, if you really want to determine with a degree of certainty whether or not you should put money into a Roth version of 401k or a pre-tax, does require some ability to forecast future tax rates. In other words, the question is it better to pay the tax now or is it better to pay the tax later? Because what a lot of people, I think, lose track of in a lot of situations is when they put money into their 401k or make deductible IRA contributions, hey, great, I didn't pay the tax. Well, you will pay the tax. It's just a question of now versus later. And this kind of gets back to how you feel about where future tax rates may be. So for, let me make it up, a 50-year-old taxpayer who's got 15 years to retirement, and they find themselves in the 24% bracket, is it better to do the pre-tax or is it better to do the Roth? Okay, well, I know if you put the money into the Roth version now, you're going to pay 24 cents on the dollar. But when you start pulling this money out 15 years from now, what rate are you going to have to pay tax? We don't know. But what we do know is based on everything we shared early in this conversation, the current tax code is accommodative. Spending levels and debt levels are problematic. These are things that would lead one to believe, you know, maybe as we get to that point in the future, maybe your rate is a little bit higher. So I do like Mike's general rule of thumb. Obviously, every situation is a little bit different, but generally speaking, 24% bracket and below can make a pretty good case for the Roth, again, situation dependent. 32 and above, the value of that deduction is significant enough that it probably does make sense to put money into the pre-tax version.
Right. And there's a lot of interplay with different things. I'm kind of bouncing around these bullets, but when you look at certain things like the child tax credit, the dependent care credit, QBI phase outs, I mean, I just had a client where added deductions this year, he actually ended up switching from Roth to traditional based on where their income was, and the interplay with all this. You know, added deductions were going to save effectively over 50% in taxes, even though there's no tax bracket that's 50%. So there can be, you know, some very nuanced calculations and situations where this does make a pretty significant difference. You know, on just the other points here: maximize income in certain brackets. Realize income if necessary. Try to defer income if possible if you're a business owner, or accelerate deductions with asset purchases. New vehicle or equipment you might be wanting this year instead of next year. HSA accounts, that's probably the most tax favorite account in existence. So you get a deduction when you put the money in, your investments grow tax-free, and you don't pay tax on it when you take the money out if you spend it for medical expenses. Medical expenses is pretty broad. It actually does include Medicare premiums too when you're of Medicare age. It doesn't include other health insurance premiums, but Medicare is specifically allowed. So those can be very advantageous accounts. And if you don't have medical expenses for some reason, if everyone's on government health care or something, you can actually just use the money like a 401k or IRA account and just pay the tax on it when you take it out. So Ryan is a big fan of those, as we are too. So certainly, if you have an
you should all be. Everyone should be. I do talk to people from time to time, and it's probably, as Mike said, one of the more tax advantage type of investment accounts that could be created. Also, one of the most underutilized at present. So I get a little animated about it because, one, it is a very compelling planning opportunity, but I also don't have access to one personally, so this makes me that much more interested in making sure as many people can do it as possible. There's a lot to health savings accounts. Mike gave a really good, just high-level overview of them. People get them confused with FSA flexible spending accounts. That's a much more widely utilized type of a way to cover healthcare-related expenses. The problem with that type of an account is it tends to be one of those use it or lose it. You basically have to consume and spend all those dollars that you contribute to an FSA in a given year. An HSA does not have that same restriction. So you actually can invest those dollars for long-term growth, plan on using those decades into the future when you know you're going to have healthcare-related expenses in retirement. So again, there's a lot more to those accounts. Just know that if any of you out there, your kids, your grandkids, if you have access to a health savings account, please do let us know, and we'd be happy to walk through whether or not utilizing it may make sense.
Perfect. 529 plans, we like those too. All tax-free growth, and you can use them for K through 12 up to $10,000. Those could be beneficial for kids and grandkids, and there's some favorable gift tax and estate tax treatments potentially if you want to super fund them in 1 year. And many states like Missouri offer a deduction on the Missouri return for that.
And Mike, one other point, just jumping in from the estate planning on the last slide. If estate taxes are an issue for a family, funding those education or medical expenses directly is not included in that $15,000 of the gift tax exemption per year. So that's something for some families they might want to do, is directly fund the education maybe of their grandchildren. So that would be writing the check to the institution directly, and that's not considered a gift for gift reporting purposes.
Yes, great point. Next slide. So charitable donations. This has been a topic of conversation forever, but more frequently since the Tax Cuts and Jobs Act raised the standard deduction to $25,000, which means far fewer taxpayers are itemizing deductions. So charitable donations are an itemized deduction. So if you aren't itemizing, you don't get a benefit of your donations. This coincided with the limitation on the state and local tax deduction of $10,000. A side comment, that actually was not in, the Democrats have long talked about changing that. That wasn't in the proposals, but it could be added to modify that. So, under current law through 2026, there can be great value to lumping your charitable donations into 1 year. As an example, if you give $10,000 a year and you only get a $10,000 state and local tax deduction, Well, your standard deduction is much higher than that, and you'll never get the benefit of that $10,000 charitable donation. If instead you lump 3 years of donations into one, you get the benefit of that $30,000 in 1 year, and then you flip to taking the standard deduction the next 2 years. Donor advised funds are a great way to do this. You can donate appreciated stock as well and avoid paying the capital gains tax on that. There's a little graphic down there that shows, and this doesn't even account for the standard deduction, itemized deduction issue I just mentioned. So even just donating appreciated stock gives you great value. Perhaps though the best option is those who are of the age to have required IRA distributions. You actually just donate directly from your IRA to the charity. That's above the line. It's not an itemized deduction. It just directly reduces your taxable income. And an IRA is a zero basis asset. Essentially, it's always taxed to yourself or your heirs. So that's a great asset to use. We're running low on time, so we'll flip to the next slide.
I just, before I do that, I just do want to add that just as it relates to charitable giving strategy, there is a lot there. It is fairly nuanced. The key takeaway I think that I would summarize is that giving cash, charities love getting cash, people love giving cash, but it's usually from a tax perspective not the best option. There's almost always a better way to do it that works not only for the donor, you still get to support a charity you care about. It works for the charity, they still get the value that they would have otherwise got, but it really can help improve the overall tax implications associated with the giving that you were going to do otherwise. So the whole point is, to the extent you intend to support a charity in any kind of meaningful way, please do talk to us or your advisor about the best way to get that done from a tax perspective.
Right. And I have had a couple clients the last few years with sales of businesses or extraordinary income events, and they'll basically fund their giving for the next 10 years through this, because they're in the top tax rate. They're never going to be at that level again. So there's a lot of planning around that, especially when there's life-changing type events. Roth IRA conversions, this is a great one to take a look at every year. The idea being tax rates are low, you realize income at the low tax rates, and allow for tax-free growth of those balances. So you're protected from future tax rate increases. And one thing that often goes overlooked is a Roth IRA is a much, much better asset to those who inherit it, especially if they're in higher tax brackets. If you can pay tax at 24% as a retired individual, and your kids are all, or whoever's inheriting the account, are all successful, they're over $450,000 of income, they're going to pay tax at 40% almost. So that can be very valuable and just a way to preserve wealth generationally and really maximize the benefits out there. So it's not just looking at yourself, it's looking at this generationally too. And that's kind of estate planning that's more obvious, but there is that with income tax planning too, and it's important to consider that as well.
Well, and in a way, they're related here with Roth conversions. And when we talk about a family that might be subject to estate tax, and if you think about an IRA that's part of that estate, the heirs would pay whatever their marginal rate is on distributions from that IRA, which could be, depending on what rates are, 40%, as Mike mentioned. Well, what if that IRA would be subject to estate tax too? And let's just say estate tax rate stays at 40. You might really only be able to preserve 20% of the value of that IRA by the time it actually gets distributed to the ultimate beneficiaries. So Roth conversions can be a really powerful, not only tax planning technique, but estate planning technique as well, for the reason that I just mentioned. Plus, recall, if you're paying the tax for a Roth conversion now, that tax cost is also removed from the estate, which again just helps out if that couple is potentially subject to eventual estate tax. And so with that, I do think we've run just about out of time today. There's a couple of questions that we would like to pose. But once again, thank you everyone for taking the time out of your morning to join us. Patti, Michael, great job, guys. You did a wonderful job walking through a fairly complex set of stuff that's going on right now. and hopefully gave people at least a few ideas of, well, at least I understand what's going on and a couple of things that I can do about it. Couple of questions, and I think we can just take them kind of as is. Any reason not to be aggressive from a tax planning perspective now, even though we're not exactly certain what's going to make it into the law? I say,
well, tax planning has to be integrated with investment planning and kind of the full picture. So yes and no. I would say it's certainly worth exploring being aggressive, but to say definitively is kind of hard to know, and how that fits into the whole picture and, you know, the whole investment and tax strategy.
Sure.
And yeah, and I would add on, each taxpayer is different. So that's, you know, to answer that for everyone that's listening, I think is a little hard, you know, not knowing the specific situations. But it's certainly, I agree, something to consider before year end.
I think just having a generally aggressive mindset, you have to still be intelligent. You still have to be rational. You still need good counsel from advisory, you know, estate and tax. But if I'm going to err on the side of one or the other, just given where I think taxes are likely to go in the future, I'm probably going to err on the side of being aggressive, just personally. We get asked from time to time, so this is a good question relevant to today's discussion, about this idea that if I convert money to a Roth IRA, okay, great, now it can grow tax-free. What if the government comes back and makes it not tax-free? Michael, Patti, any issue in your mind, any threat of that being a reality?
I mean, it could happen.
It's the government, anything could happen.
Right.
It's possible, but I struggle with that happening. I struggle with the idea of them doing that as opposed to making it prospective. But, you know,
yeah, that seems to be one that would not be too palatable, or if this is my personal commentary, I have no real basis for it, but if they did that, perhaps it's on, you know, the Peter Thiel type people who have billions of dollars in their Roth accounts, or, you know, are in a 5 million plus or 50 million plus or whatever income taxable income threshold they want to set. But that would seem to be very unpopular among many constituents, I would think.
Mm-hmm.
Yeah, I would be inclined to agree, and I think, as Patti said, if they want to limit the potential benefits for Roth, I think the way you do that is making it harder to get dollars into the Roth in the first place. And we've seen several examples of that in proposals that you guys just walked through.
Right. Yeah,
just making it right.
And making you take it out too. So
exactly.
it can never grow to a level they're not, you know, comfortable with. It's going to have to be taken out. So.
Just a question on a little bit about, this is complicated, this is complex, but as it relates to grantor trusts and ILITs, and we talked about what is the effective date of that is basically the question, which my understanding is when it becomes law, which,
correct.
How do you plan around that? It makes it very, very, very difficult to be able to actually do anything. Given the level of concern currently, you may remember we went through the same exact thing last year with Blue Wave and how that was going to significantly alter the estate planning landscape. Turns out that didn't really move in that direction. But the advice last year, I think, still good advice this year. You do the best you can within the parameters of the law with what you know, and stay connected to your appropriate estate planning counsel and follow that recommendation.
Absolutely.
That's probably, I think, one other question about, I don't think we covered it, but Mike, you talked about the larger standard deduction that started basically under the Trump tax code, Tax Cuts Jobs Act, starting in 2018. We haven't seen anything in the proposal about that amount being cut down, correct?
No, nothing in there about that or the state and local tax deduction cap.
Which obviously could change. I mean, that's like everything else that we've talked about today, it could change. So we are just about out of time. If you had a question interview out there that we didn't get to today, please just follow up with us, either Michael or Patti directly or with Brand, if that makes sense. We're always happy to answer any questions you still have. But with that, again, I'd just like to once again thank everybody for tuning in today. Hopefully you found this informative. maybe a little bit scary, but at least we're watching it. We're going to try to do the best we can with whatever changes do come. There will be changes. Tax codes are never static. They're never the same for too long. And we always do the best we can within any given year to do the planning that makes sense for that year, for the years into the future, which you have to dedicate the time and energy to doing that. Mike illustrated that point. You have to have that conversation, that planning discussion each and every year, and you can't do it after the end of the year, right? Because by then it's too late. So it really is important to sit down towards the end of each year and determine where are we at, where are things headed, at least to the best of our knowledge, and what should we do as a result of that, with the overarching goal, once again, of not minimizing this year's taxes, minimizing the lifetime taxes that you and your family pay. Yeah, that's really the more important number there. So we're always going to do everything we can possible to try to make that happen. So with that, we'll go ahead and sign off. Again, thanks everyone for joining. Thank you, Patty and Mike. You guys did a great job, very informative. Hope everyone has a great rest of the day, great rest of the week, and stays in good health.
Thanks for having us.
Thanks, Ryan.
Our pleasure. Our pleasure.